Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. It's Friday, the 9th of September. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. Just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. And here is the market commentaries disclaimer. I just want to double check. Everyone hearing me okay? Just let me know if there's any sound. Okay, cool. Thank you. Alrighty, and here's our references. So let me bring up a chart just so there's something on the screen. But whilst TradingView is loading up, let's go through the Bloomberg 5 things to know. And it reads as follows. So the first headline is entitled Mourning, M-O-U-R-N-I-N-G, and it reads that the death of Queen Elizabeth II at the age of 96 prompted an outpouring of condolences from around the world. Ascending the throne in 1952, Elizabeth's reign took Britain from the age of steam to the era of the smartphone and encompassed a largely peaceful breakup of an empire that once spanned the globe. Her passing marks the start of a tumultuous 10 days for the UK that will see the Queen buried and the new King proclaimed as the nation mourns its longest reigning monarch. Charles, the eldest of Elizabeth's 4 children, will be formally proclaimed King in a ceremony dating back hundreds of years. At 73, he is the oldest person to accede to the throne in British history. The next headline reads Energy Crisis. The European Union is throwing together a series of radical plans to tame runaway. Sorry, I'm just going to turn the sound off. The European Union is throwing together a series of radical plans to tame runaway energy prices to keep the lights on across the continent, but governments across the region are going to need to find common ground quickly. The bloc's energy ministers gather in Brussels today to take the first step on ways to prevent Russian President Vladimir Putin's cutoff of gas supplies from unleashing rationing, blackouts, or even social unrest. And as inflation soars, European Central Bank officials are prepared to deliver another jumbo interest rate increase at their October meeting if needed, according to people familiar with the debate. Their counterparts in the US also continue to be hawkish, with Federal Reserve Jerome Powell saying officials won't flinch in the battle to curb inflation. More weapons. The US is looking to ramp up support for Ukraine more than 6 months after Russia's invasion began and ahead of a new round of European sanctions in December that could lead to price spikes for energy. The Biden administration offered $2.8 billion in weapons and military financing to Ukraine and its neighbors. President Joe Biden also held a video call with leaders of the Group of Seven and the EU to discuss new ways to make sure Europe gets sustainable, affordable energy supplies. $504 million saved. The federal appeals court saved Citigroup from an epic blunder that became the talk of Wall Street, rejecting a ruling that Revlon creditors could keep more than $500 million the bank accidentally sent them. I'm actually reading a few stories like this, by the way. After a decision process, one expert compared to the Twilight Zone, a trio of judges in Manhattan on Thursday, overturned the trial court's surprise decision early last year that the lenders, which include Brigade Capital Management, HPS Investment Partners, and Symphony Asset Management, didn't have to return $504 million that the bank had mistakenly wired them in 2020. European stocks are set to nudge higher, following gains in the US and Asia, while the euro advanced. EU officials meet in Brussels to discuss emergency intervention in energy markets. The region's finance ministers meet in Prague. US President Joe Biden travels to Ohio to attend the groundbreaking of a new Intel facility and discuss the CHIPS Act. Expected data include Norway inflation, Spain industrial production. All right, I think let's do some analysis with all that said and done. And what I want to take a look at is, of course, euro US dollar, because yesterday we saw the 75 basis point hike in the EU, and I just want to discuss my thoughts around that. Obviously, get your thoughts as well. But I put it up the wrong template. All right, so I'll just wait for it to download. In the meantime, what we can see is that here it is. Okay, what we can see here is the German 2-year against the US 2-year. Okay, so we're looking at the relative spread, or the spread between the front end of the yield curves, which effectively are controlled by central bank policy. And you can see that the Fed, a big one, and the ECB is actually the more aggressive of the two, according to the spread. So the spread is certainly moving in the ECB's favor. But what's interesting here for me is, of course, even though there is a spread advantage as per the fixed income market, that's not been reflected in the euro US dollar. In fact, euro US dollar has been trending down. Now, what we do have to acknowledge, we do see a gap here. Okay, so there is obviously a change up in the spread sentiment, because this is a big gap. And of course, you can see that the euro US dollar has a strong positive candle. However, let's just try and unpack why the euro US dollar seems to be defying what otherwise looks like a fairly good spread that should be benefiting euro US dollar. And my thoughts are as follows. Number one, the statement and the press conference revealed some key information. Number one, the inflation that the ECB is fighting is supply side inflation. The speech constantly referred to energy inflation, and energy inflation is simply not going to be controlled by the ECB. It's a political issue. So they can pump interest rates up as high as they want. What that is effectively going to do with regards to the economy is slow down what we call the demand side of the economy. The best way to understand that is just to think about how we would, our own behavior concerning credit cards. If credit card interest rates become too steep, we'll cut back. It's going to become expensive for us. It cuts back on the credit we're using. It cuts back on our demand. That's where the Fed, not the Fed, the ECB works. That's where any central bank works. It's got nothing to do with the demand supply situation of energy and natural gas. So if that's the case, and the ECB has decided to be rampant with their hikes, and they are, 75 basis points is the highest since the start of the monetary union. And then the question is, why would they be doing that? Number one, what's the side effect of that? And the second issue why I think the euro US dollar is moving opposite to what looks like a really good spread for the Eurozone is because the ECB, in my opinion, and I think in a fair amount of analysis, analytical sort of opinions, is they downplaying the risk of recession. Their statement yesterday made no provision for recession. In fact, they're seeing growth. Now, that of course may be the case, okay, but there are strong probabilities that suggest recession as well. In other words, what one would think, let's get rid of this, that there should be some sort of acknowledgement. There's kind of two parts here, right? One leads to growth and one leads to recession, and you've got to attach probabilities to them. Now, if you kind of let's call this economic growth, and let's call this economic recession. What you've got to do is you've got to assign probabilities to this. This is called a probability tree. So what you want to do is, okay, well, we've maybe got a 60% chance here. Let's put in a percent. And we've got a 40% chance here. Okay. And or perhaps it would be something like this. Maybe there's a 40% growth and a 60% recession. So one would think that you would have to acknowledge some sort of probability that you can fall into recession, especially because of the headwinds that the global economy is still facing. But they didn't mention it once. So I would suggest that there is some sort of underplaying of this leg of the probability tree. Now, again, I'm not saying that there is going to be a recession. My opinion is that there are strong probabilities to suggest that we could go into recession. However, what I do think is that the ECB is not even mentioning that. Okay, so if the ECB is not even mentioning that, okay, then we've got to ask ourselves this question, and this is the biggest question. What's the risk? Okay, what's the risk that ECB has head in the sand? Okay. Which I think is an appropriate question to ask. There should be some sort of acknowledgement that there's at least a possibility of recession. There should be so what's the risk? So I think the risk is fairly high. So if there is a high risk, okay, then you want to protect yourself. That is called looking for a safe haven. So if there is a high risk that the ECB is kind of got their head buried in the sand, well, you go back to the euro US dollar and you ask yourself, well, where's the safe haven? And clearly, the dollar is a safe haven, despite the fact that we've got the spread moving in the ECB's favor. We're not seeing that reflected in euro US dollar. And just to kind of summarize the pointer, the chances for that is because I don't think that the ECB rate hikes are going to control the inflation to the level that they want. And number two, The fact that they are underscoring the possibilities of recession, it's probably got sort of market participants running straight towards the dollar for that very fact, saying, I'm going to put my money into the dollar. It's safer. Now, there's one other thing we need to discuss here, and then we'll go into sort of a more sort of trading analysis. We'll start using market scope. But just before we do that, this is also a huge danger. So you've got now, this is just very sort of basic. We've done this before. Very basic supply and demand model. Demand is going to have the negative slope. Supply has the positive slope. Now we're talking about supply shocks. Okay, talking about supply shocks. So that means we're going to have to do something with the supply curve. Okay, but before we do that, let's call this inflation, and let's just call this economic activity. All right. So we've done this before, but what a supply shock means is that there's less supply going around. Think about Nord Stream 1 being turned off, so there's less supply. So if there's less supply, okay, it shifts to the left. The model will tell us that, okay, well, you've shifted to the left. Well, guess what? Now you've got higher inflation. You've also got lower economic activity. So that's what this model tells us. Now, we've already said that the interest rates hikes probably won't control your supply side inflation. But we've also said that they act not on the supply side, they act on the demand side. That was our credit card example. So the higher rates are going to shift demand to the left. So let's make that blue. And that's where the ECB comes in, right? That's where the ECB comes in. So now we've got a intersection here. So yes, there's a little bit of a tiny sort of impact on our inflation. It does drop to about there, but at the same time, you've killed economic activity even further. So now let's just use a black. So this is where we were originally, and now we're at the blue. So you can see that the economic activity here has been obliterated. Okay, we've gone this way. In terms of the, let's just say this black inflation, let's just say that is ECB target. Okay, well, they've got closer to target, but they've got as far as they can possibly go. All right, without damaging the economy even more. So they're not going to get to target, okay, according to this model, and they're going to hurt the economy. That's again playing into the hands of safe havens, right? That's exactly the point. It's playing into the hands of safe havens. So now, okay, we've got this really interesting situation that there is a big bump up in the in the euro, and that's where we're going to start our analysis now on market scope. Okay. So yes, there is a movement up here in the euro. Okay, how this plays out now, I think is going to be very interesting. If the situation unfolds as we've just discussed, then I would look at this as perhaps some sort of corrective move. And if it's some sort of corrective move, it's exploitable. Okay, it's exploitable. And we've just looked at that on the euro side of things. We haven't even talked about quantitative tightening. Is a HP possibly forming in the euro-US dollar? A higher peak on the, so I think that's on the daily. So here, so I think this is what Anna's referring to, which the answer to it is, of course, yeah, we're probably getting some sort of HP here. But remember, what we want to do is we want to get a primary trend. Okay, we want to get a primary trend here. So we want to see if there's going to be an HP on this one, because then that would, an HP on the weekly follows fundamentals. So I would suggest if there is going to be an HP on the weekly, we likely don't get a spike like this. I mean, I wouldn't bet money that we don't get a huge. Well, I would bet money because I would trade it, right? But I mean, I wouldn't bank on just a spark moving up like this. But if we get something like this, that would be very positive for the euro. In other words, instead of the HP, we get the HT, so we get the higher trough, then we get the HP. That would be very positive, and that would be a head and shoulders. Okay, so that's something that we can certainly look towards. And if we do get something like that, we would need to again unpack it on a fundamental basis. But my feeling is that yes, there is some sort of movement going on here, and that's reflective in the daily. But I'm not certain we're going to get the same kind of reaction on the weekly, and that's the first point. The second point is, of course, yeah, let's go down to the daily now and see what's going on. So, of course, the daily is looking strong. Yeah, of course, it's looking strong. It has got this kind of HP here, and it is moving into zone 1. Okay, but because of, I think, the fact that the US dollar still remains fairly compelling as a safe haven, and I think it remains compelling because of quantitative tightening. My thoughts right now, and I'm going to tag on that subject to correction, is that this is probably something that's exploitable, okay, until proven otherwise. And what these, remember, on the dailies, what are we looking for on the dailies? Well, I like doing the peak and trough analysis on the weekly, and I like trying to find the corrections on the weekly. And then what I want to do on the daily is I want to try to find the patterns. Okay, this is where I think the classical patterns really can be analyzed. So remember, here was our wedge. Okay, something like that. Here was a wedge. Okay, so yeah, we kind of get the HPs on the daily, and of course that aligns up with the I don't know this. I want to read it. I think this is more like a flag. Can't quite get it the way I want. It's enhanced, so I'm just going to put it like this. I think the first time was probably the better way. All right. The point is, yeah, the higher peaks on the daily, sure, but that's running with the current sentiment, and of course, in our day trading course, that's going to be super important. But in terms of, well, hang on a second, some sort of correction in the primary trend, are we building some sort of pattern here, which we're going to have to wait and see. And if we get some sort of pattern here, is it going to break down? In other words, I'm looking for a continuation pattern. Again, where the situation changes, I think, would be if we get an inverse head and shoulders on the weekly. Now, I think the last point just to make here is the higher peak in of itself doesn't make the trend, but it does break a downtrend, because the definition of a downtrend is a lower peak followed by a lower trough. So if we get the euro breaking this this peak over here, then we do get that HP. Then we do get the higher peak. We don't get the uptrend yet. The uptrend would be once we get the higher trough followed by the higher peak. And again, this is a head and shoulders. It's just an upward sloping one. So what we're looking for now is some sort of head and shoulders pattern, either down sloping or upward sloping or sort of lateral. It's something that suggests a change up on the primary trend. But something like this, in of itself, needs to be watched carefully. And the reason I say that is we just go back to the S&P 500. And we did get something like that in the S&P 500. Now, the S&P 500, this is looking very, very interesting. And this could be sort of a model that the euro follows. Watch this very, very carefully here. So again, we're on the weekly. Okay? Let's put in our peaks and troughs here. Watch this very carefully. So here we've got peak, trough, okay? Now here we've got HP, which we did pick up before, okay? But that HP actually led to a vicious 3-week sell-off. But this is where the change up is getting very, very interesting. What is this? Are we seeing a higher trough here? Okay, so the HP, yeah, that was kind of interesting, but this now is getting way more interesting, because if we kind of get this on the S&P, all right, then we do get that HTHP. Then we actually do get the head and shoulders. Okay, here would be the inverse head and shoulders. So the left shoulder, right shoulder. That would be a fundamental change up in trend, whilst everyone is shouting that the markets are haven't bottomed yet. This HT question mark, that's got to raise our eyebrows. Okay, that's got to raise our eyebrows. What do the letters mean? P. Okay, let me write this in. P stands for peak. Okay. T stands for trough. HP, that stands for higher peak. And the opposite for that mirror would be lower peak. Okay. So yeah, we've got higher peak. Yeah, we've got higher trough question mark, right? And the reason we do this, because effectively Dow theory, sort of the grandfather of all of the technical analysis, has actually given us the definition of a trend, and it's it stood the test of time over 100 years. Uptrend is a higher trough followed by a higher peak, and a downtrend is a lower peak followed by a lower trough. So this is now very, very interesting. One more thing, okay, with regards to the S&P 500 is, just take this guy out. Okay, you can see where I'm going with this, right? Monthly, is that in the Copac? And let's just sort of marry the peak and trough with the Copac. So let's just put in the Zero down. And for some odd reason, it didn't keep my setting before, so I just want to throw a 3-period exponential here. Length 3, yeah, that's fine. Okay, make this blue. Okay, cool. Very good. All right. Okay, I see how it's working. All right, so it did actually keep my, let's make this, save that as a D. I think that should work. Okay, so let's just marry the analysis together. Kopok indicator, which is effectively trying to catch bottoms. It's not flawless. It does give false signals. However, it does require 2 triggers. We've got 1 out of 2. It's dropped below 0. So we are in value territory. Now, the thing about value territory, you know, it may be cheap now, but it could be cheap, but could become cheaper, right? So we're waiting. That leads us to the second trigger. Second trigger must turn up. So we haven't got it turning up yet. That's what we're waiting for. But let's just assume that we're pretty close to the nadir, the bottom, right? Let's just, I don't know where it is, but let's just say it's going to be somewhere sort of between -10 around, right? That's of course an assumption. Then you go through to your weekly chart. Well, now we're getting the potential trough, perhaps higher peak. So in other words, we may be getting to that renewed confidence stage. So while everyone else is shouting bloody murder, we're kind of thinking, well, wait a moment. There's bargains to be had here. Now, you can't just rush in on the Kopok indicator. I don't know if this is going to turn up or not. It hasn't turned up. It hasn't given a signal. It can drop all the way down to previous levels. There's still a lot of headwinds that the economy is facing, right? But the point is, it's not all doom and gloom on a technical chart. Where it will be doom and gloom on a technical chart is when we get this. Then it's dropped below this. Then it's dropped below this trough. Yeah, well, then we're making lows. That's doom and gloom. Okay. Or this would be doom and gloom. We kind of get a movement up. It doesn't quite give us a higher peak. It gives us a low peak, and then we get a lower trough. That's doom and gloom because there's the downtrend reasserting. So, and that's possible, right? The economy is facing huge headwinds. Yields are moving up. The higher the yields move, the more pressure on the risk markets. However, what I'm suggesting is, well, let's just watch. Is this a HT? If it's an HT, do we get an HP? Then there are fundamental changes that are taking place, and they'll be recognized sooner or later. All right. I think if there is any questions, please go ahead and type them through. Yeah, so that's my feeling as well. So Anna's just writes, she understands the euro has gone up as a first response to the interest rate hike, but if the interest rate hike cannot affect supply side inflation, it doesn't really make sense. And that's I agree with. One assumes that large market participants know what they are doing. So that's my worry. That's my worry. So we're going to have to keep an eye out on this, how this develops. And you've actually kind of, in my opinion, sort of hit the nail sort of on the head. You know, the whole point is that I don't think all is okay. This kind of move up in the euro does look suspicious to me, and I could easily be wrong, you know. But until proven otherwise, I'm very nervous that this is a is suspect. And let's see how we trade for the rest of the day. And then, of course, this is going to become a theme for us until we get some sort of clarity. So Mia, have you got? I think it's a good opportunity. Yeah. Mia, do you have access to our Telegram? Do you have access to our Telegram? No. Okay. So just email me. Just email me. I'll just give you. I'll write out my email address. I'll send you the information for the Telegram, because I'm going to put this up on Telegram. So just email me at this address. Okay, and then the US dollar moves in the opposite direction of the euro US dollar. Yeah, well, it's got to, right? If the euro is moving up and we're looking at the euro relative to the US dollar, well, then the US dollar has got to be moving down. Yeah. So that would make sense, right? That would make sense. Again, I would suggest that if the dollar is the safe haven, then there could be an opportunity here for a sort of buy the dip. So we just want to keep an eye on this as well. So they'll move in tandem. And yeah, and it would be inverse to S&P as well. So the S&P is under huge pressure. Again, dollar is the safe haven of choice at the moment. So any sort of pullback on the safe haven and any sort of movement up on the risky side of the market, well, the obvious question, Derek, is that legitimate? You know, is that a legitimate move? And it could very well be, by the way. But my initial feeling, until proven otherwise, is it's suspicious. And I think that's what we're going to examine over the next week. Any other questions there? Okay, cool. No worries. I'll respond to that, Mia. All right, let's wrap up here, guys. And I will see you on Monday then. Have a good day, good weekend ahead, and we'll chat on the other side. Thanks, guys.